Welcome, everyone. We are starting with chapter 4 today. I promise you this is going to be much easier than the other chapters. Chapter 3 was a tough one, but this one is actually going to be much easier for you guys. So what we're really focusing on today is would be internal controls, with the primary focus on reconciliating a bank statement. Now, I'm not going to even ask you guys, but in the past, for the past 10 years, when I asked students, has anyone reconciled a bank statement? People don't even know what I'm talking about. So you're going to learn how to reconcile a bank statement today, okay? So, good morning. So we've got the focus on cash. We're going to learn about cash. We're going to learn about why companies have internal controls in place. And we're going to focus on learning about a bank statement and journal entries involving that bank statement. Now, financial statements can be in error. Oftentimes those errors are really accidents. You know, we just put it to the wrong account, or we may have an incorrect number. But it's honest that errors happen. We're human. Internal controls will try to attempt to correct those type of human errors, but internal controls are focused on trying to prevent fraud. Fraud is when one person intentionally deceives another person for either personal gain or to harm a company or a person. Occupational fraud is the use of one's occupation for personal enrichment, or through the deliberate misuse or misapplication of the employer's resources. For fraud to occur, there must be 3 elements. The individual must have an opportunity for fraud to occur. They're open to being able to commit a wrongdoing. Inside the person, they've got to have some type of need. Someone feels the need to commit fraud, such as the need for money. But then they also have to rationalize their behavior. They justify their behavior. They may say, oh, I'll pay it back. They may say, you know what, they're not paying me enough. I deserve more. I'm just going to take a little more. There's some way in which they justify this behavior. I'm going to pause this. So know that it needs those 3 elements for fraud to occur. The reason we put internal controls into place is to only stop the element called opportunity. We can't change people's motivation or, you know, what they think, how they justify behavior. But what we can do is get rid of the opportunity for it to happen, which is what internal controls are about. They're about protecting the company's assets and helping to improve the accuracy and the reliability of accounting information. So there is a law passed in 2002 called the Sarbanes-Oxley Act. The reason it passed is because back in the early 2000s, there was so much fraud occurring. WorldCom, Enron, even in locally, we had some scam cases. I think it's always happened, but they just, you know, became so big and toppled over, and many people lost a ton of money in their life savings. So, and most of this fraud occurred from upper management, upper CEOs. those were the main people that were responsible for the fraud. People were just disingenuous. They misreported and misused company funds. Two of the biggest ones, Enron and WorldCom, collapsed overnight because of stupid, greed. And so Congress passed the Sox Act. That's what we call it, the Sox Act. Sarbanes and Oxley, two of the congressmen who initiated this law. And one of the things they did is they required all companies that have to report to the SEC, which are basically public companies. They required new guidelines for them. One being internal control procedures and the relationship between external auditors and the clients. So the big thing we care about is they required a new guideline on internal control where every year the top management had to document and assess that internal controls were working effectively. And then the company's auditors had to review those internal controls and write an opinion if they agreed. A big thing for how the Sarbanes-Oxley Act has changed the corporate America. Do I think fraud still occurs? Absolutely, all the time. It just maybe put a little damper on it. So because of the scandals in the early 2000s, the Sarbanes-Oxley Act was passed, and it had a bunch of guidelines related to how they needed to discuss their internal controls. Which of the following statements is not true about the Sarbanes-Oxley Act? What do you guys think? Do all companies fall under it? No. The only companies that fall under it are just public companies, the ones that are required to report to the Securities and Exchange Commission. So companies that are not public companies, that do not have public shareholders, are not required to report on this. So as far as internal controls go, the base is what we call the control environment. It's kind of the tone of the company, and the ethical tone really starts at the top. This control environment can include policies related to management's philosophy, the organizational structure of a company, and who's responsible for what. Next step is what we call a risk assessment, where we look at the internal controls and we look at the internal and external risk factors related to this particular company. So for example, when you're dealing with a casino, what is the first thing you think about? What is a potential of risk? Cash, tons of cash. As a result of all the cash, they've got to have strict internal controls in place. They have cameras. They have only certain people handling the money, and those people are being watched probably by two other people. You know what I'm saying? Whenever they're take money out of a machine or however they do it, there's usually at least two people, because of the risk, inherent risk of just dealing with cash. Because of the risk, they come up with procedures. The control activities are the policies and procedures that help ensure that the management's goals are being carried out. This would include who authorizes certain transactions, who reconciles the various transactions, and then the various separation of duties. Finally, monitoring. After you set these in place, you have to make sure they're working. So that's what monitoring is all about. The monitoring is just a continual review and checking to make sure those control activities are functioning as they're supposed to be. No, there are preventative controls. This prevents errors from happening. Separation of duties is where possibly the one who's selling the movie tickets at a cinema doesn't account for cash at the end of the day. Or physical controls. The concession supply should be kept in a locked room with only access allowed by certain employees. Proper authorization would be that theater's management should only be the ones that are authorized to make purchases over a certain amount. Employee management, employees should be made fully aware of the company's internal control procedures, their ethical responsibilities, and channels for reporting irregular activities. And then e-commerce control firewall settings. Now, those are preventative controls. Detective controls will help locate, hopefully, something that has gone awry. Reconciliations, where you review periodically or systematically that the physical assets of a company agree with what the accounting records show. Performance reviews is you look and see, okay, if this amount of concessions are sold, how does this relate to the tickets that were sold? And you draw some type of analysis. And then in audits, you hire an external independent auditors to just look at the internal control procedures and see if anything's awry or amiss. The CEO and the CFO each year, because of SOX, must sign a report certifying that the internal controls are in place and effective and working as they should be. The auditors each year for public companies provide an opinion on management's view of internal controls over financial reporting, and they provide their own opinion as to what's working well. So guys, what do you think here? If a company places cash receipts from the day in a safe or bank deposit box, this would be an example of separation of duties, physical control, reconciliation, or performance review. What do you think? What do you think?
B?
B is perfect. Yes, physical control. I was just checking to make sure you guys weren't all asleep. Do you know that? Correct. So what we're going to do now is we are going to look at these various statements. And we're going to see, do we agree or not? Is it true or is it not true? The components of internal control are built on the foundation of the ethical tone set by top management. That sounds good to me. Oops. That's true. Once every 3 months, managers need to review operations to ensure that control procedures work effectively.
That's true.
It's not, only because they said once every 3 months. It should happen probably throughout the week. Okay?
Okay.
Collusion, we didn't talk about this yet, but collusion refers to the act of a single individual circumventing internal control procedures.
False.
False. Collusion is 2 or more. Detective control procedures are designed to detect errors or fraud that have already occurred, while preventative control procedures are designed to keep errors or fraud from occurring in the first place. That's true. Okay. Next, fraud committed by top level employees is more difficult to detect because those employees more often have the ability to override internal control features.
True.
True. That's the problem. You know, the higher up they go, they have the ability to not adhere to those guidelines in place. Now, this is false. I'll explain why. A good example of separation of duties would be have one person collect the cash from customers and account for it. No, one person collect the cash and another person to account for it. Or having one person order inventory and another person maintain control over it. Do you
I got
see?
a question.
Yes, hon.
So when I was reading this the first time I saw that, couldn't collusion happen with this too if the two people were working together?
Absolutely. Collusion, of course it would happen. That's the problem, is collusion when two people try to come together and scam. It's easy to happen because they have separate duties.
Yep.
And so they can come together and really create havoc. You're exactly right. It's a tough one. Sometimes that's why it's good to change people's duties up here and there, you know?
Mhm.
Employee tips. Now, guys, this one's going to surprise you. Employee tips historically have been the most common means of detecting employee fraud. Do you know that is true? Detective controls include reconciling the physical assets of the company with the company's records and comparing actual performance of individuals or processes against their expected performance. Correct. Okay, guys, everyone's going to help on number 9. Okay. Effective internal controls and ethical employees ensure a company's success. What do you think?
False.
False. You know why? It's great to have wonderful internal controls and great employees, but that doesn't promote the success of a business. You've got to have something people want. You know, there's a lot more to success of a company. These are two nice things, but it is not going to ensure a company's success. Okay. Let's just kind of move on. Everyone in the company has an impact on the operations and effectiveness of internal controls, but who must take the final responsibility? The top executives. They are ultimately responsible. So this one here is a scenario where there's different situations, and each scenario determine which control activity is being violated. Control activities include separation of duties, physical controls, proper authorization, employee management, reconciliations, and performance reviews. If no control activity is violated, state none. I want you to take a couple minutes and attempt this, okay? Okay, so guys, a manufacturing company compares total sales in the current year to those in the previous year, but does not compare the cost of production. What is being violated here?
Reconcile.
Performance reviews? They're not reviewing it.
Oh.
So that employees can have easy access to office supplies, a company keeps supplies in unlocked cabinets in multiple locations. What's wrong here? Physical controls? At the end of each day, a single employee collects all cash received from customers, records the total, and makes the deposit at the bank. What is wrong here? Separation of duties, isn't it? At the end of the year only, that's the issue, only, the company compares its cash records to the bank records. They need to do monthly reconciliations, don't they? A company encourages employees to call an anonymous hotline if they believe other employees are circumventing internal control features. Nothing's being violated here. This is a good thing to do. Tip lines are great. What's wrong here? All employees have the authority to refund a customer's money. There should only be certain people that authorize that kind of activity, right? Okay. Any questions before we move on? Anything? Okay. We're going to talk about what is cash and what we call cash equivalents. Cash can include savings accounts, checks, coins, checking accounts, credit card sales, debit card sales, or cash equivalents. They are all considered cash. Which of the following would not be considered a cash equivalent?
Money orders. Money orders.
Actually, cash is a current asset. Wouldn't a certificate of deposit that matures 1 year from now not be a current asset? It's not available to be used. Correct?
Makes
So
sense.
credit card sales for the day or debit card or money orders are all instant. But a CD that isn't going to mature for a year is not a cash equivalent. So let's understand some guidelines for having controls over cash. Collection of payments from customers can happen in a variety of ways. I was just reading or listening to NPR on the way in, and they're really trying to get digital currency to be legal in the United States. It's crazy how things are changing.
Is that like Bitcoin?
I guess I don't really know much about it, but they think that by having digitalized currency, more people will use it, which I don't know. But controls over cash and checks. These are some good options. Open the mail each day and make a list of cash and checks received, including the amount and payer's name. Designate an employee to deposit cash and checks into the company's bank account each day, but a different person from the person who receives the cash and checks. That's a separation of duties.
Yep.
Have another employee record cash receipts in the accounting records as soon as possible. Verify cash receipts by comparing the bank deposit slip with the accounting records. Then accept credit card or debit cards to limit the amount of cash employees handle. You guys see on airplanes, they do that now. If you want to drink in the airplane, you can't use cash. You have to use a credit card, some form of plastic in order to, and why are they doing that? So the money can't slip away. The acceptance of credit cards provides an additional control by reducing employees' need to directly handle cash. Meanwhile, the credit card company deposits cash in the company's bank for the amount of the sale less the service fee. This is important because you're going to see this on your quiz. When a movie theater accepts MasterCard as payment for $2,000 worth of movie tickets, and MasterCard charges the movie theater a service fee of 3%, no, the revenue is still $2,000. The service fee is an expense for doing business. Remember how we match our revenues with our expenses? The service fee is an expense, but the revenues still get reported at $2,000. Okay?
So I have a question.
Yes.
Why are they charging the 3% to the company though, and not the card holder?
Because when we use credit cards, the company is providing us with a service, and that's their way of getting paid. You know, think about when, I think of all the people who default on their credit cards. We got to pay for that somehow. These credit card companies are providing a service. It's not free. So that's how they pay people to utilize their services. With American Express, I don't know what we pay, but let me tell you, American Express has saved us so many times, because if we have ever a fraudulent transaction, they'll immediately trust us and take it off and make them fight with someone else. We had that happen. I don't know how someone got our number, but they ordered truck tires for like $4,000. They thought it was weird how they called in the credit card and then they were going to come pick them up. And so they were a little curious. They came in, they asked to see the credit card. They said, oh, we'll have to go out to the car and get it, and left. Now, how they got our credit card, I still don't know, but they were at least savvy to say, hey, let's see your credit card, just because it was odd how they handled it. So guys, they've got to make money too, and that's how they make money. So you don't see that as the customer, but the company who is using that credit card pays. So note here though, the service fee is $2,000. Or excuse me, the service revenue is $2,000. The service fee is an expense. Like credit cards, debit cards offer customers a way to purchase goods and services. Can someone unmute? Because that's annoying. Or mute, I should say. Like credit cards, debit cards offer customers a way to purchase goods and services without a physical exchange of cash. The difference though, debit cards work like a check and withdraw funds directly from the cardholder's bank account at the time of use. Similar to credit cards, the use of debit cards by customers results in a fee being charged to the retailer. Usually the fees charged for debit cards are lower than those charged for credit cards. Okay, so remember, great ways to handle cash disbursements is to make disbursements by check, debit card, or credit card, because it provides a permanent record. Authorize all expenditures before purchase and verify the accuracy of the purchase itself. The employee who authorizes payment should not also be the employee who writes the check. Make sure checks are serially numbered and signed by authorized employees. Sometimes 2 signatures are required for larger checks. These are good internal controls. Periodically compare amounts shown in the debit card and credit card statement with purchase receipts. The employee verifying the accuracy of the debit card and credit card statements should not also be the employee responsible for actual purchases. Set maximum purchase limits on debit cards and credit cards. Give approval to purchase above those amounts only to higher employees. Employees responsible for making cash disbursements should not also be in charge of cash receipts. It makes total sense, doesn't it? So remember, a movie theater pays $1,000 to advertise its showtime. If the movie pays with a check, a cash, or a debit card, you debit the expense and you credit cash. However, if the movie theater pays that $1,000 by paying with a credit card, you show a credit to accounts payable. Okay, I need to fix this one here. It's a credit card, then you credit accounts payable, you don't credit cash. Because cash is the asset of a company most susceptible to employee fraud, controls over cash receipts and cash disbursements are important for internal controls. These controls include separation of duties and also authorization and specific documentation procedures. Here are a list of good controls for receipts, good controls for disbursements. The key with a lot of this is having separation of duties and having proper authorization for transactions to occur. Now we're going to get to the nitty-gritty here. We are going to look at how to reconcile a bank statement. In order to do a bank reconciliation, we need to know the balance of cash in the company's books and the bank balance. They're not going to be the same. And they're not going to be the same generally due to timing differences or possibly some errors. So what a bank reconciliation does is it matches the balance of cash in the bank account with the balance of cash in the company's own records. Now, the reason they're going to be different is because things might have happened on the company side that haven't hit the bank yet, or there may be transactions the bank has seen, the company has not recorded yet. So here we see a list of cash accounts. We see for the company cash receipts, cash disbursements. We see the balance of March 1st, 2024 started at $23,600. We add the receipts, we subtract the disbursements, and we get an ending balance. These are the company's records. Here is the bank statement. The bank statement also starts with a beginning balance and an ending balance and shows the deposits and the withdrawals. And of course, the ending balance. The first thing we do is take the ending balances. We take those balances, excuse me, I'm getting way ahead of myself. Okay. The most important thing to start with is we take the ending balance of the company, the ending balance of the bank, And that's the beginning of how we reconcile the bank statement. Remember, the bank statement refer to an increase or a deposit in the cash balance as a credit, and the decrease as a withdrawal is going to be a debit. Remember why? The bank is recording your money in its books, and your bank account in the bank's view is a liability to them. So think about when you make a deposit, the bank debits cash, credits the liability, your account. When you make withdrawals, the bank will credit their own cash, but then debit your account. So if you understand why a bank will call a deposit a credit and a withdrawal a debit, it makes sense if you look at it from the bank's perspective, okay? Because that really can confuse so many students. The reason for the difference in terminology is a difference in perspective. When a company makes a deposit, it views this as an increase to cash, so it records a debit to cash. But the bank views the same deposit as an increase in the amount owed to the company or a liability, which is recorded as a credit. Don't forget that, guys. So when we reconcile a bank account, we are going to first start with the company's bank balance, the bank's balance, the company's balance, and then we're going to update the company's cash account by recording items coming up here. So to reconcile the bank side, we're going to look at deposits and withdrawals that the company's processed, but the bank, it hasn't hit the bank yet. These are going to include deposits outstanding and checks outstanding. Cash receipts of the company that have not been added to the bank's record of the company's balance. And then same with checks. Checks the company's written that have not been subtracted from the bank's record.
Can I ask a question?
Yeah.
So with these two, because I got really, really confused. With these two, is this considered negative on the bank standpoint?
Well, deposits would increase the
Right.
reconciliation to the bank because it increases cash. The checks would decrease.
Okay.
So just hang in there with me because we'll go through them, okay?
Okay.
So as you see here, here are deposits for the bank. Here are the company's records. That both matches. Those match, but look what doesn't match. The company shows on March 30th sales of 8,500. That didn't hit the bank yet, did it? Right? And do you see there are some things here at the bank that the company doesn't have in their records? So the items, this is a deposit outstanding. What that means is it hit the company, it's outstanding with the bank. These items are items the bank saw, but have not yet hit the company. This is something we'll record on the bank side. Also with disbursements, you see all of these match up except the company showed a $3,000 advertising cost, but the bank shows it to be $3,300. In this scenario, the bank is right. Usually speaking, when it comes to deposits and check validity, not always, but usually the bank is right. Now, sometimes banks can make errors without a doubt, but on this deal, they realized they in fact only recorded it for 3,000 when it should have been 3,300. Here, here you see this check hasn't hit the bank yet. And do you see over here, these disbursements from the bank have not yet been recorded by the company? Yes.
So when the bank makes this, or if you make a mistake of $3,000, the one thing that I'm not understanding is, how come it says that you increase the bank's 300, or like there was a problem that I was getting continuously wrong, where it would say that the bank made an actual mistake of it was 1,000, you checked for 1,000, but they accidentally did 1,300.
Okay.
And then it would be like the bank adds the extra $300 or something.
I'll have to look at a problem and see.
Okay.
What was the
Usually,
question?
well, a student just had questions regarding, with some problems that he did. He was a little confused why the bank made some adjustments. Let's wait and go through a bunch of problems, and I think that might solve it, because sometimes it helps to talk it through. So here is the bank reconciliation for this problem. The bank's balance, we got that from the bank statement. Here is the company's balance through their records. The first thing we're going to do is reconcile the bank's balance. The items on the bank's balance is outstanding deposits, outstanding checks, and any errors possibly. Do you see this 8,500 was outstanding from here? Okay. This was in the company's records, but did not hit the bank statement yet. That 8,500 we add to this balance because deposits are added, checks subtract the balance. So on the bank side, we add our deposits, subtract our checks to come up with an ending balance. On the company side, we find things that the bank showed that we don't have in our books. Now it shows back here that the bank received a note for the company that had not yet been recorded in the company's books, along with $200 of interest. So we are going to show that here, the note received plus interest earned on the note of $200. We look at the disbursements. Here we show a $4,100 electronic funds transfer. This was a $2,800 NSF, which means a customer paid their bill. We went to deposit it, but it wasn't any good. So it got returned to us. It's not the company having an NSF, it's the customer has an NSF. And then here's a $100 service fee. So we need to adjust these items in our books. We need to show the electronic fund transfers for utilities, the NSF check from the customer that we thought increased our bank account, but it was bad, so it decreases it again. The service fee of 100. And since we put in our books, the advertising expense was only 3,000 instead of 3,300, we need to adjust that. Do you see at the end of this, our bank shows not 29.5 and our company balance shows 29.5? We reconcile. The one thing we need to do are all these transactions that affected the company's balance, we need to create journal entries for it. we have to go and create journal entries. So we record these transactions in our books. Okay. Which of the following items would be found on the bank side or the left-hand side of the bank reconciliation? Interest income received on the account, deposits outstanding, an NSF from a customer, or service fees charged by the bank.
NSF. Is this more than one answer or just one?
So this is reconciliation items that we would be putting on the bank side to reconcile with the books.
Oh, okay. So then it would be deposits outstanding.
Correct. It would be deposits outstanding. Because deposits outstanding are something we would show on the bank side. How would an NSF check from a customer be treated on a bank statement reconciliation?
A deduction on the
Company side. So we have to show, getting back to that problem, we have to record journal entries for the items that we adjusted on the company side. So we received cash of $2,200. We have to show a notes receivable as a credit of $2,000, and interest receivable from the note is $200. We then need to show items on the company side that decreased our cash, the utility expense, the accounts receivable. Remember the NSF check that we thought the customer wrote us, but is not good. We have to now increase that receivable. The service fee expense and the advertising expense reduces our cash. We never do journal entries for the bank side. We always do them for the company side. Okay? This you write down. This is so important. This really helps you know what you record. Okay, write that one down, really key. Excuse me, just one sec here. Okay. This is key. And keep that beside you when you're doing homework or your quiz. Who just showed up? Who just showed up now?
Oh, it's just me. I'm on 2 devices.
Oh, okay, gotcha, dear. Okay, got that, guys? Can we move on? You want another minute? You bet, dear. Okay. In a bank reconciliation, remember, we reconcile the bank's cash balance for cash transactions already recorded by the company, but not yet recorded by the bank, and possibly any bank errors. Similarly, we reconcile the company's cash balance for cash transactions already recorded by the bank, but not yet recorded by the company, and company errors. After we complete the reconciliations, the amount for the bank balance and the company balance should be equal. How would, oh, I'm not going to worry about that one yet. Okay. Let's look at this problem. This is the best way to help you guys. I wish I could shut this thing down, and I don't know how. Oh, hide video panel. Does that do it? Oh, yay. Oh, took me all this time to figure this out. Spielberg Company's general ledger shows a checking account balance of $22,970 on July 31st, 2022. The July cash receipts of $1,885 included in the general ledger balance are placed in the night depository at the bank on July 31st and processed by the bank on August 1st. The bank statement dated July 31st shows bank service fees of $55. The bank processes all checks written by the company by July 31st and lists them on the bank statement, except for one check totaling $1,460. The bank statement shows a balance of $22,490 on July 31st. Prepare a bank reconciliation to calculate the correct ending balance of cash on July 31st, 2022. The first thing we do is we put the balances. Do you see? We go and find the bank balance on July 31st, $22,490. Then we go and find the company's balance, $22,970. First step. Okay, first step. Next step, we will reconcile the bank side. The deposits outstanding tells us that the July cash receipts of $1885 included in the general ledger balance got placed in the night depository at the bank on July 31st, but it didn't get processed by the bank until August 1st. So we know it didn't hit the bank statement in July. Therefore, we need to add that $1,885 deposit outstanding to the bank. The company has it recorded, but the bank doesn't. Then it tells us the bank processes all checks written by the company by July 31st and lists them on the bank statement, except for one check totaling $1,460. So what it's telling us is that check is outstanding. So we need to subtract that check to come up with the bank balance per reconciliation of $22,915. Again, these are things the company recorded that hasn't hit the bank yet. Yes.
For deposits outstanding, will we have to write positive, or can we just write 1885?
I'm sorry.
For a deposit outstanding, do we have to do positive 18, like the symbol? As a
Well, we will want to add it. So you don't necessarily have to do a plus. It'll add it without a plus. But on the checks, you're going to have to do a minus.
Yeah. Okay.
Got it.
Yeah.
Yes. Now we're going to look at the company side. The only thing the bank shows are service fees of $55. Those service fees are going to come on the now be put on the company side as a minus. And do you see now we reconcile? Both sides are at $22,915. Make sense? Now we are going to have to record any journal entries that hit the company side. The only one that hit the company side is a service fee expense of $55, and we credit our cash for $55. Okay. Let's look at this one. This one's got a little more meat to it. On October 31st, 2022, Damon Company's general ledger shows a checking account balance of $83.97. First thing I do, I put that over on the company side. Then it tells us the company's cash receipts for the month total $74,320, of which $71,295 has been deposited in the bank. What does that mean? The difference hasn't been deposited yet, right? In addition, the company has written checks for $72,467, of which $70,982 has been processed by the bank. What does that mean? The difference hasn't been processed by the bank yet, so they're outstanding. So we know what we have to do on deposits outstanding and disbursements outstanding. We're going to show that on the company, on the bank side. Then it tells us the bank statement reveals an ending balance of $11,727. So we know where to put that. And includes the following items not yet recorded by Damon. Bank service fees of $150, note receivable collected by the bank of $5,000, and interest earned on the account balance plus from the note of $320. After closer inspection, Damon realizes that the bank incorrectly charged the company's account $300 for an automatic withdrawal that should have been charged to another customer's account, and the bank agrees. So the bank accidentally took money out of their account in error. We're going to record a bank reconciliation. The first thing we do is show the bank balance and the company's balance. Then to record the bank's reconciliation, we add deposits outstanding. We subtract checks outstanding. Now the bank agreed they screwed up. So we're going to add $300 back to the bank account, the bank side, because they're going to fix that for us. The company, we start with the balance. We add things that the bank shows that the company has yet shown. The bank received a note from a customer for $5,000. The bank also received the interest from that note of $320. And then there were service fees the bank charged us of $150. We'll add the note on the company side. We'll add the interest. And we'll subtract the service fee. Do you see that we balance at the end? Now, the next step is any changes we made over here on the company side, we need to report a journal entry. So we are going to show our cash increased $5,320 because we received a note. We credit when we received a note. We're not going to receive it anymore. It's zeroed out. We show interest revenue of $320. This is to record the note and interest collected by the bank. Then we will show a service fee expense of $150, and we will credit our cash. Does that make sense? Yes? No? Let's do another one for homework, okay? Oh my goodness, I can't remember how to get in there. Oh my goodness, what's it gonna be? Nope. Oh, shoot. Lord. You know, I get so used to just trusting those, password, they just put them up for you. Sorry, guys. Okay, should have worked. Okay. Let's look here on your homework. Okay. Here is a bank statement. The problem regarding reconciling a bank statement. Oscar's Red Carpet Store maintains a checking account with Academy Bank. Oscar's sells carpet each day, but makes bank deposits only once per week. The following provides information from the company's cash ledger for the month ending February 28th, 2024. So it's giving us the deposits, the checks, and the balances. Okay. Then it tells us information from February's bank statement, and company records reveal the following information. The ending cash balance recorded in the bank statement is $13,145. What are we going to do with that number?
I'm gonna write it down.
We're going to put it over here. Bank's balance per bank statement. We know the balance per the company is 13,200, right? Right? First thing to do. Then it tells us cash receipts of $1,600 from February 26th through 28th are outstanding. What do we do with deposits outstanding? Look at that page you wrote down.
You would show it on the company side, but it doesn't show up on the bank side yet.
No.
Right? No.
Look at that. Remember this one? Remember this? We show this on the bank's cash balance, deposits outstanding minus checks outstanding. So we are going to go back here. And the cash receipts of 1,600, we add here, don't we? Deposits outstanding. 1,600, right? Then it says checks 325 and 327 are outstanding. What do we do there? We go and find checks 325 and 327. One is 200 and one is 1,900. We're going to show 2,100 checks outstanding, right? But I need to put in a minus there. Okay. Next, the deposit on February 11th includes a customer's check for $200 that did not clear the bank. What does that mean? Where do we show items related to NSFs? On the company side.
As a negative.
So $200, we're going to have to subtract NSFs minus $200, right?
Yeah. Do you have to skip a line?
Well, I just did because I know I'm going to have something up here. You know, I just am kind of doing it as we go along.
Oh, okay.
Now, check 323 was written for 2,800 for advertising in February. The bank properly recorded the check for this amount. Check 323. Look, we recorded it for 2,500. We screwed up, right? Company error of $300.
So really it's 322, or do we just minus the $100?
Okay, look what it says again. Check 323 was written for $2,800 for advertising in February. The bank properly recorded the check. They're telling us it should have been 2,800. We showed it to be 2,500. We need to show it to be $300 more than what we said. So we have to show that company error of $300.
Why would we subtract it for gaining more?
We're not gaining more.
You said it was 2,800.
But look what the company only showed it to be 2,500. And this is a check we paid. So it just check subtract. Okay. Next. An EFT withdrawal for Oscar's February rent was made on February 4th for $1,100. So we would show an EFT for rent. How much was it? 2,400? No, 1,100. Okay, next. Debit card transactions include $4,700 of legal fees expense and $400 of entertainment expense. So they're telling me they hit the bank, but we didn't record it yet. So we are going to show debit card for legal fees minus 4,700. And what was the entertainment? 400.
Yeah.
Okay. In January, One of Oscar's suppliers, Titanic Fabrics, borrowed $6,000 from Oscar. On February 24th, Titanic paid $6,270. The $6,000 borrowed plus $270 of interest directly to Academy Bank in payment for January's borrowing. This then, the bank has it, we don't have it. We will show note collected, 6,000. Interest collected, 270, right? Then it tells us Academy Bank charged a service fee of $125 to Oscar for the month. Okay, you guys, why don't you give me the balances? 14,745, 12, 645. Y'all get it? Someone add them, please. I'm sorry, what?
So when we do the adding, are we including the per general ledger too, or not? Like the top?
Yeah, absolutely, sweetie. Yes, because that's a balance.
Okay.
Come on, guys, someone has to have it.
I got 12,645.
Awesome. It's what we want. Do we balance? We balance. Okay. Now, the next step is to take these transactions or these changes we show on the company side and create a journal entry. So we've got our notes collected and the interest. Let's do that one first. Record the amounts that increase, cash. We will debit or cash. And what will we credit, guys?
Accounts. On accounts, record the accounts that increase cash. Oh,
What are we going to record, guys? A notes receivable
I'm so confused.
of 6,000 and interest revenue 270, right? Then the amounts that decrease cash, we need to show the $300, I forget all the ones. Wasn't that one for advertising? We had a $300 error. We had an NSF check. Was the $300 error for advertising? I think it was. Yep, advertising. Rent withdrawal. Legal fees, entertainment. Okay, so the first thing we're going to need to do How come I'm having a difficult finding?
Ms. Schumake, I am so lost right
Okay,
now.
well, I'm trying to help. One sec, honey.
Okay,
I'm sorry.
Click on the table.
The what?
Click right there.
Thank you. Now two. Okay. So then we're going to take legal expense of what? 1,100 or no, 4,400, wasn't it? We have advertising expense, 300. We had entertainment expense of how much?
it's like 400.
We had service fees of how much? One what?
125.
What else are we missing here? I feel like there's more.
The rent expense.
Rent, I had 1,100. Did I make? Maybe I didn't put that in. Rent,
Yeah, we don't have that.
rent expense 1,100. And we credit our cash. $44.55, 59, 62, 63.25. See if I'm missing something. Legal fees expense must have been 4,000, not 4,400.
4,700.
4,700. I'm sorry. And what else am I doing wrong?
Isn't it supposed to
You
be,
have to do the rent
rent
expense.
expense? No, you don't.
Thank you. And so our new cash should be 47.58, 9, 60, 61, 65, 66.25. Right? Oh, Lord, what am I doing wrong? 47, 5, 54, 55, 25, 66, 25. Well, trying to figure out what I did wrong.
So right now, are you adding all of the expenses to get the cash?
Yes,
Okay,
disbursements. They asked me to do deposits first and then disbursements.
okay.
Okay, let me see what I did wrong. What am I missing, guys?
Just say cash doesn't flow.
Yeah,
What?
it says that cash is wrong. It's supposed to be something else.
47,
That's why
5,
that number's wrong.
54,
66.
55, 25, 66, 25. That's just,
We have to change cash.
I know, I'm just trying to figure out what we need to change it to. I'm adding them. So what have I done wrong? So I am going to sneak and look at what 68.25 accounts receivable. Oh my gosh, that's what I'm missing, guys. We're missing the person who did the NSF. Remember how we got an NSF?
Uh-huh.
200. And then our cash will be 68.25.
Accounts receivable.
So what are we doing here? We have to take everything, every transaction. How that just kicked out of me, I don't know. We have to take every transaction related to the company side. And we then have to create a journal entry for everything we changed on the company side. Okay. I have to move on so we can finish up with this. So how do we account for employee purchases? Most companies have what we call a petty cash fund, where we use for small purchases or for small items. And companies also issue credit cards or debit cards for managers to utilize. So when a petty cash fund is established, you're going to just debit the petty cash account and credit your cash. As the items get used in the petty cash, we'll show this expense and continue to replenish our petty cash fund. Credit cards were given to different managers to purchase items. Remember, when credit cards are used, it's not cash. It will go into accounts payable. But items with debit cards or cash will be credited to cash. So to record these purchases, we will show lunch as an entertainment expense for 60. We will show the delivery expense of 90. We show supplies of the 800 plus the 600 of 1400. We show advertising expense of 1500, postage of 1200. The items that went into the petty cash of 150 we use as cash. The others are a credit to accounts payable for 4100. Remember, petty cash is used against cash. Credit cards are used against accounts payable. Okay. To replenish our petty cash fund, since we've already used up 150 of it, we just debit our petty cash and credit our cash. It basically, we add more cash to our petty cash fund to keep it at that minimum balance. Just know the biggest key here are debit cards and petty cash go against cash. If any manager uses credit cards, it goes against accounts payable. The last piece we want to talk about relates to the statement of cash flows. We've talked about this a couple times, but we report cash in the balance sheet and we also report it in our statement of cash flows. Our statement of cash flows separates all cash activities in 3 sections. Operating activities are activities involved with why the company's in business. Money from customers or cash from customers, and then expenses paid with cash. Investing activities are cash related to the purchase and sale of long-term assets. And then financing activities relate to borrowing money or issuing stock and paying dividends. That's it. Remember, the statement of cash flows is only for the use of cash. So when you look at these transactions that we started the book with regarding the soccer company, we went through and decided, were they financing, were they investing, or were they operating activities? So we have them listed here, but items that are not linked with cash are not added to the statement of cash flows. Do you see number 5 where it says purchase supplies on account for $23,000? It was on account. We didn't use cash. Therefore, we are not going to put this into our statement of cash flows. Also, do you see where it said provide soccer training to customers on account 20,000? Did we receive cash? No. Therefore, we will not show that on our statement of cash flows. So how we would create a statement of cash flows, we start with operating activities. Number 6 and 8 were inflows, cash inflows from customers. 6 here provided soccer training to customers for cash, 43,000. Number 8 received cash in advance for 12 soccer training lessons, 6,000. Do you see how those two are added into the operating activity section? The outflows are for salaries and rent. Number 9 and number 4. Paid salaries to employees, 28. Paid 1 year rent in advance, 60,000. You see how those go in here? To get net cash flows from operating activities. Then we purchased equipment for cash, 120. That's investing. And then financing is issuing stock, borrowing from the bank, and paying dividends. We then have our net cash flows from the operating, investing, and financing, showing an increase here of 137,000. And if we had a cash balance at the beginning of the period, we'd put it here to then get our cash balance at the end of the period. And that should also be linked to the cash shown on the balance sheet. Which of the following items would be categorized as an investing activity on a statement of cash flows? Borrowed money from the bank by signing a note to repay the full amount, paid for supplies in cash, paid for the purchase of equipment using cash, or paid salaries to employees. What do you guys think?
Is it C?
Perfect. Remember, investing have to do with the purchase and sale of long-term assets. Excellent. Now, oftentimes, while cash, you don't want to necessarily have a lot of cash just sitting idly. You need cash in order to pay your bills. I'm not going to go through this problem. You guys feel free to look at this problem 4 or 5B because it just kind of goes through all the process. And I think you might even have a problem like that in your homework. So guys, this chapter, actually, if you just go back and look at these, this lecture, and let this bank statement sink in, it's pretty darn straightforward. Remember that one slide I showed you. This is key to understanding the bank statement. On the bank side, you're going to add deposits outstanding and subtract the checks outstanding, plus or minus any bank errors. On the company side, you're going to add everything that the bank recorded that the company does not yet have. Everything that you put on that company side has to have a journal entry because we want our books to balance the new reconciled balance. And the only way to get that to balance is to create journal entries. So we then have the updated balance. Are there any questions you guys have? as far as your homework, you've
Yeah, I was
got-
just, oh, I'm sorry. I was just gonna ask you if I could see that last part we just did on the chapter 4 homework.
Okay, I'll put it up right here.
All right, thank you.
You bet. So here is the reconciliation. Here are the journal entries.
Okay, thank you.
You bet. Remember, the journal entries are only for the company side. Here is another transaction, bank reconciliation. And again, remember, everything from the company side will need to have a journal entry. Next. This is preparing a statement of cash flows. Again, remember, only items involving cash are put in the statement of cash flows. This last one, you create the journal entries. Then you check those items involving cash. Then you do a T account and post the transactions. And then you create a statement of cash flows. I believe the quiz has like four small fill in the blanks, and the rest are multiple choice. Pretty straightforward, but if you guys understand what we're doing here, you've got it. Okay. Honestly, guys, this stuff is so much easier than what you've just dealt with in chapters 1, 2, and 3. If you have any questions with homework, make sure you post them in the discussion and let other class, students help. And then I also look at that daily as the steward. Okay, guys? Any questions at all? Anything? Well, you guys have, I can't even find, you guys have a great week, and I will see you in D2L. Bye, guys.